What is up, everybody? Welcome back to the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host here, Kyle Ryan, as always. Today, we are going to honestly just have a conversation about the market and what is going on right now and how to essentially digest it and think about how you want to consider investing in this type of a market. And what I mean by that is interest rates are a lot higher than they normally have been over the last, I would say, 2 decades, Kyle. I think
Yeah.
that's kind of the going rate right now. It's really altered how the stock market has reacted to that, but also the bond market, the fixed income market, and how that's reacted to that, because we haven't seen this type of interest, this type of yield in a long time. And I think one of the other things that we're going to talk about is the real estate market as well. We've gotten a lot of questions on real estate market as far as buying a primary residence or buying possibly a rental property. So we're going to dive into that. But before we really get started, Kyle, would love to just kind of get your overall take on this conversation in particular, but also just your take on where the market's at right now.
Yeah, this episode we're gonna be talking a lot about how interest rates can impact a lot of things, whether it's like you mentioned, real estate, equities, stock market, fixed income, the bond market. We'll talk about all that stuff, how it impacts each of them in very different ways. Whether you're rising like we currently are, when you're at the top and you're plateaued, which we could be, or when you're going down in an interest rate. But yeah, the market right now, it's been a little bit shocking, a little bit surprising the way it's behaved this year with a rising interest rate environment, which we'll talk about how stocks behave in this environment normally. But yeah, no, there's a lot to unpack here. There's a lot of head scratching going on by economists and analysts all over the world right now. So I'm really excited to dive in on this one.
Yeah. And I think you really brought out an interesting point here. It's kind of shocking how the market performed so far this year. Now, obviously, we don't have a crystal ball into the future and what the market's going to do for the rest of the year, but a large majority of the people in this industry did not think that we would see the recovery that we saw, especially at least in just the first half, January to June of this year. We didn't think that we were going to see 35% up on the NASDAQ.
No.
I mean, at least our own team's contention was we thought we were going to be very flat this year, anywhere from down 2% to up 5%. That was just kind of our in the office. We've been doing this for a while, kind of our general thought on where we thought the market would be. And I think there's a lot of positives to what we saw. There's also some things I think we want to be cautious of. I think the positives is, on this conversation of rising interest rates, is I think we saw, obviously in the first half, some companies that really were not managing their cash balance sheet very well. And that was those banks that went under, right? Yep. That's where you definitely saw companies that weren't managing their monies correctly. But at the same time, we saw a lot of companies that did have a solid balance sheet, did have a lot of cash, and started to really benefit from those rising rates. Now, obviously, it kind of stunted their growth a little bit, because that's something that you do need to recognize in an environment like this, is when you're wanting to invest in the stock market, you do need to alter to a degree your, what I would call your midterm expectations of performance, is the next 1 to 2 to maybe even 3 years, because these raised interest rates are going to decrease overall growth in publicly traded companies. That's just normally how rising rate environments work. But the reality is you want to use that as an opportunity to place yourself inside of those companies or inside of those funds, so that when rates plateau and companies get comfortable, and then also if rates were to go down, it would work in the opposite direction where you start to see even more growth, right? I think that's what we saw a lot in the 2010s. I'd love to get your take on that.
Think about it from your own perspective, not even just from a company. It could be even easier to understand, right? If I have more of my working expenses, my dollars, more of them going to my debt payments because interest rates are higher, I have less to work with.
Yeah.
It can personally grow my money less. Companies work the same way, right? If they all have debt out there, so if their debt is costing them more, then they can grow that much less. So innately, you're going to have companies that rely more on research and development, the sort of technology growthier names. They'll typically rely a lot more on growth, not from paying dividends, but from actually growing their stock value and increasing their earnings potential.
Yeah.
Without having that extra free cash flow, they limit their ability to do that more so than other companies who don't rely on that earnings growth. They rely on their, the stabilized dividends that they pay out, the frequent and often cash flow that they pay out, the investors expect. That hasn't decreased, thankfully. But yeah, these companies that are trying to research and develop their way into the future, they're slowly but surely having to cut themselves off a little bit. And one of the really interesting things about this year that I'm sure we'll talk about at some point is AI. I mean, that's a huge reason that, a lot of these companies were able to grow so much because the expectations for future growth in the AI. But at the same time, because their costs are becoming more constrained, employees need to get paid more, their single greatest expense, their debt needs to get serviced, that's getting more expensive. It's limiting how much money they can put into these other resources.
Yeah. Yeah, 100%. I think the AI is a really interesting piece. I also think that the chip piece as well is super interesting, because I think that we saw basically a very small subset of companies and the primary index, which is the S&P 500, that were either really diving into AI or really heavily focused on chip manufacturing, that performed tremendously well this year. I think we're starting to see a little bit of a pullback in that because the recovery was so huge. And a few of the companies, I'm not going to name any names here because we don't want to be touching up with the compliance team, but I think that that's something that is starting to come into play. And the question, at least that I have, is when we see rates start to level off or even decrease, where's the growth with them? Right. That's another thing to consider. So now is a time where, that sector might be somewhat attractive to take a look at. Now, obviously, that's depending on your situation. What I wanted to transition into was kind of the opposite side of the investing world, which is the bond market, the fixed income market. And, we talked a little bit about this actually in our 2022 recap episode that we did in January. And the idea that in 2022, we saw the fastest raising of interest rates in history for America, as far as going from essentially zero to almost 4.25% in a span of 12 months. Now, what does that actually do to your bond investments? And, Kyle, I'd love to just have you kind of talk through the process that we spoke about a little bit offline, as far as, how bond attractiveness starts to shift as interest rates go up, like what that can do to bond investments.
Yeah, I always love to explain bonds and their relationship to interest rates like a seesaw, right? So if you imagine a seesaw, right? So when interest rates are high, if you can't see my interest, my hand's pointed up. When interest rates are high, that means that bond prices are low, right? It costs you less to buy something that's yielding more. And then the inverse happens when rates rise, the bond price goes down. Yeah. Right. Because you're getting paid more to own it. So essentially what's happening is in 2022, rates were at near zero because we were at COVID lows. So we have a basically zero interest rate environment that got one of the fastest rate hiking cycles we've ever seen throughout 2022. Rates rose like crazy. Therefore, bond prices saw one of their worst performances in history since the U.S. aggregate bond index came out. We saw its worst performance in 2022. And that's, it's really interesting to think about, because I remember hearing this concept the first time thinking, well, what happened in the 80s? Because in the 80s, we had interest rates go from, I don't know where they started, but they got all the way up to 15, 16%. Mm-hmm. So you'd think that bond funds would have done worse back then. But it's actually a multiple of where they started, right? Because we started at 0 and went to 5. It's a huge increase. If you go from 5 to 15, that's a 3 times increase. It's not as much as 0 to 5. That's why the bond market was just absolutely shocked and blindsided by the move. Really hurt them. But moving forward, right? So now we're at either the peak or close to the peak of our interest rate cycle, depending on what inflation does. You have to anticipate that over the next year or so that we'll start to cut interest rates. So go back to my seesaw, we're at interest rates high, bond prices low. Now, if interest rates start to decrease, you're going to have an increase in bond prices. Your yield on the bonds is going to go down, but your price is going to go up. You'll get some capital appreciation. So from a 30,000 foot view, that's kind of how they work. Yeah.
Yeah. I think that's kind of the interesting part that we want to make sure that people take home here is you want to recognize that when essentially the cycle of how you should view and value the bond positions that you own, if you own any, when rates are going up versus when they're flat and stabilized versus when they're starting to decline. And that's essentially just a period of the economic cycle as the Fed and Chairman Powell view it, right? So we're
Yep.
kind of up to their own discretion and how they anticipate and recognize where we're at. But overall, it's just important to, at the very least, just recognize A, how bonds fluctuate, but B, how they tend to operate in different parts of the market cycle. I think it's super important. Moving into the
One other
yeah,
thing
did
on
you
that,
have one other
Thomas,
thing?
before
Yeah,
you move on. Yeah, because not all bond funds are built the same. The
that's
same way
true.
that not stock funds are built the same, right? If you have an industrial stock, it's not going to perform the same as a technology stock, right? They're just innately different. The same way bond funds can be very different from one another. And it really comes down to what's referred to as duration. How long that bond fund will take, or that bond itself will take to mature, is what's called its duration. The longer your duration, essentially, the more, I don't know if the right word is risk, but the more risk you're taking, the more volatile that bond will be. Meaning that longer duration bonds, when you have a move in interest rate, will have a much sharper move in their corresponding prices than will short duration bonds. And I know that was a lot. So what that means is that to be really safe, if you have, the safest thing is cash assets, treasury bonds, right? But if you're in a bond fund that is subject to a little bit of risk, your ultra short bond fund will be subject to a lot less movement and volatility, because on the short end of the curve, on the interest rate curve, there's not as much room for it to move as there is on the long side of the curve. I like to think of it like a whip. The short end of the whip, it's not going to move that much.
Yeah.
Interest rates, you want low duration. You get less subject to the volatility risk. And then as you think interest rates are going to decline, that could be a worthwhile time to increase your duration.
Yeah.
Same way as on the stock side, at certain times, those growth funds are going to do better than those value funds because they perform differently in different economic cycles.
Yeah. I think that is important. I appreciate you stopping and bringing that up because, just at least recognize the fact that you can buy a 6-month bond or a 1-year bond or a 5-year bond or a 30-year bond, right? The 30 years are the super long-term ones. And recognizing that there's different pros and cons and different opportunities and risks involved with each one, and putting together a portfolio that leverages and optimizes each of those specific bond types when the opportunity is available, I think is super important.
And one other thing I just remind me of before we move on to real estate is if you ever heard the word inverted yield curve, the term, right? So what does that mean, right? That means that you're getting paid more to take on short duration risk than long duration risk. Okay. Typically, if you're investing your money in something for longer, you want to get paid more because your money is tied up in that thing for longer.
Yep.
Versus short term, you expect to get less. When you have what's called an inverted yield curve, which is what we've been experiencing for about a year and a half, that is historically a very accurate predictor of a recession. Why? That's because long term, I'm not willing to take the risk to buy long term because of the economic uncertainty in the front end. I am willing to get paid more because of the economic uncertainty in a short term bond when we're going into recession, so the yields would be higher. So if you're ever wondering what the inverted yield curve is, it's because people are anticipating a recession and they're not willing to take as much short-term risk, so it has to pay them more. So I just wanted to cover that one as well.
Yeah, and I think that's, an interesting part in this whole economic situation, because at least from the majority of the people on Wall Street, the majority of people in the government, we really haven't entered into a legitimate recession yet. And this inverted yield curve has been going on for about 16 months now.
It's a lot of indications that are pointing that way, and they just haven't come to fruition.
Yeah, so I'm super curious to kind of see what the future holds there. Onto real estate.
Yep.
This is probably the number one question that I've gotten from anybody under the age of 35, probably, especially if they don't own a primary residence or haven't purchased their first home yet, is how should I think about the real estate market right now? How should I think about buying a house? And I'd love to get your take on this. I'm going to give my take just real quick. My personal opinion is the reality across the United States in particular, especially if you live in a high volume city, demand is not slowing down. Supply is not getting any better. and everybody and their brother is thinking about waiting until rates go down. So if you decide to wait until rates go down, right? That's just a possibility. We don't know if that's going to happen or when that's going to happen. So recognizing that and trying to almost like beat everybody to the punch where we can evaluate and say, hey, I'd rather buy now when the competition isn't as high against trying to wait, because what most likely will happen is demand will increase again, supply will continue to be constrained, and prices will start to shoot again. And, that's kind of my overall take on it. So Chris, we are kind of messed up here. Okay. Are you good?
Yeah, I don't know what happened. My Wi-Fi kicked out, so hopefully that doesn't happen again.
I honestly, dude, I think Chris should be able to cut this.
Yeah, I mean, I took note of what you said as you cut it. It was especially if you live in a high volume city, so we could try again. So you could just say, hey, let's talk about real estate, and it'll just cut it over that, because that's kind of what you said.
Yeah, that's true. Okay.
Sorry about that. I have no idea what happened.
Because you kind of cut out earlier, and I was able to just kind of recognize it, not say anything, and then you came back. But okay, let me yeah.
You think about it.
Okay.
Yeah, my connection was unstable. I didn't think it would do that though.
Yeah. Okay, you ready?
Yep.
Okay, so let's talk about real estate. So this is probably the question that I get the most, at least right now, for anybody who hasn't purchased their first home. This is normally, people age 32 and younger, is how should I think about the real estate market right now? And in my personal opinion, I think the reality is, especially if you live in a densely populated area, you got to recognize that the demand for homes is not going down. At least in the short term, the supply of homes is not going to get better. At least it's not going to get tremendously better. And everybody and their brother is waiting for interest rates to go down. So if you do the same and wait for interest rates to go down to avoid a higher monthly payment for a relatively short period of time, at least in the consensus of what we're predicting interest rates to look like over the next 12 to 16 months, then you are going to have to participate in all of those other people re-entering the real estate market, demand getting even higher, supply getting even tighter, and prices going back up, right? And so we're going to run into what we saw in the late 2020s, early 2021, and you're going to just be in a rut again, where instead of battling interest rates, you're going to be battling home prices. And I think the question is, how quickly are they going to bring rates back down in comparison to how much home prices are going to shoot up when rates do start to fall? I think that's kind of an interesting question to think about, is in comparison to those two things, I would rather have a higher rate with a much more average or relative valued price on a home and then refinance later than have a slightly lower rate, like maybe 1%, but pay $30,000, $40,000, $50,000 extra on a home. I mean, that's my personal opinion.
Unfortunately, the reality is you're dealing with both, right? You're dealing with the increased home price and a higher mortgage rate. So I strongly agree with your opinion. I've got two opinions. One's my personal and one's my professional. My professional opinion, I agree with you, right? Professionally, I think that if you want a home and you're interested in buying a home, you don't want to rent, do it, right? Okay. If you of course, determine if you can afford to do so.
Yes.
And it depends. Are you looking at it as a home to live in, or as an investment? Your first one,
Sure.
You're going to flip it. Huge difference on both sides, which way you look at it, right? Because if you're looking at it as an investment, who knows, right? I don't know what the market's going to bring, right? But it historically, we could be at closer to the height of the cycle. There's so many factors that go into this that I almost want to make the joke like this time it's different, because we have never had a low interest rate environment like we did. Everyone and their mother refinance. I can't even imagine what percentage of mortgages are below 4% right now. I'm sure it's the vast majority of them. So you're not having any influx of inventory from people selling. You still have people with all this COVID stimulus still somehow in their pockets. So they're willing to buy a house. We've been ready to buy a house for years, a lot of Americans. So high demand, low inventory. And so professionally, I think if you want to get a house, you can always refinance it. Just make sure it's within your price range. Me personally, with my little tinfoil hat on, I want to buy a house really bad personally. I would love to buy a house. I just don't see myself buying a house right now. Even if I had the ability to do so in a couple months, whatever, I just don't think I would. Me personally, with my tinfoil hat on, I was reading statistics, and it's going to vary by where you live, but a lot of what happened in 2020 and 2021, a lot of the single family rentals, a lot of single family units, I should say, and multifamily units, they got bought in by people who are looking to do short-term rentals. Short-term rentals strip a lot of the inventory off the market of people who are looking to do either long-term rentals or buy a home. So you have a lot of people, the Airbnbs of the world, right? You have a lot of people who are trying to get short-term rentals in the game. That is a costly thing, because if you're doing short-term rentals, you're viewing it as an investment property. If the real estate environment changes and we do go into a recession and people start losing their jobs and they start cutting interest rates, like this glorious thing that everyone says we want to start cutting interest rates, it's just going to go to the moon from there. There has to be a reason they're cutting interest rates, right? Because when they're cutting interest rates, they're trying to bolster the economy. Why would they bolster the economy? Maybe people are losing their jobs. So if people start losing their jobs and investors in real estate start getting hurt, they could start really laying out and start selling their properties, which would be an increase in demand. And subsequently, on the other side, if you have the consumers are hurting, we're not willing to buy a house anymore because we might not be able to. I might not have the money in my account anymore because the market went down or what have you, or I might have lost my job. I need a little bit more in emergency savings. Maybe the supply goes down too. Supply and demand goes down, equilibrium point comes down, you have a decrease in home prices, and you're going to be stuck in a pre-2008, pre-2001 housing price that you might never get out of.
Yeah.
And now I'll take my conspiracy hat off. Every single area is different. That's common in some parts of the country, especially like the Californias of the world. I know PA and major cities it is in certain cities. So just be really aware of the real estate market you're in. And at the end of the day, if you want to buy a house to own a house and to live in something and make it yours, go ahead and buy it. But if it's an investment, my conspiracy senses are tingling.
Yeah, for sure. And, I think that that's where like a lot of it comes into the type of loan that you get. And, that's a topic for a whole other episode, but there are a lot of unique situations and circumstances that you have to recognize. And I think that that's kind of the benefit of having somebody like us, of having a relationship with an advisor. Is this is a conversation that you get away with somebody who's completely impartial to your personal situation or your personal feelings on it. And they're going to give you their professional opinion based off of your specific personalized circumstances, what the thought process could possibly look like, weighing the opportunities, and benefits, the pros and cons, and the risks that are inherent in situations like this. So, if you have any questions about your personal situation that involve anything that we've talked about today, whether that's, your stock market portfolio, if you want to invest in bonds, if you're looking at real estate, this is something, that we'd love to reach out and talk to you about. One of the other things too, Kyle, we didn't get to it today. Maybe we get to it in another episode, or somebody can just give us a call and reach out, is what to do with your cash positions, right? Because we're finally getting an opportunity where high yield savings is actually yielding savings. It's actually worth something. And so, if you have questions about these things, please reach out. We'd love to work with you. But at the end of the day, thank you to everybody that's watching and listening, and we will see you next time.